Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to yet another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. The results from the first half of the year are in, and dealmakers cooked up $2.5 trillion worth of transactions. We're going to take a look at some of the biggest winners. Plus, the top deal-making advisor by several measures in the first half of this year is Sullivan Cromwell. Their global head of M&A, Melissa Sawyer, joins us just moments from now. Plus, Care Bears and AOL in the news today. It's a retro show. We'll tell you how AOL is returning to public markets and the story behind Care Bears changing hands. But first, to our big deals, and we start today with telecom. Comcast is planning to spin off NBCUniversal, and European media property Sky reversing course after more than a decade of struggling to demonstrate the benefits of a cable and media conglomerate. Also, Verizon has struck a deal with UK's BT Group. For all of that and more, Bloomberg Deals senior reporter Michelle Davis joins us on these stories, and you've been closely tracking these deals and the sector. I mean, Comcast has been through a lot of corporate transformation. What's the thinking behind this latest move from them?
This is a deal that's been speculated forever. I mean, investors and analysts have really wanted Comcast to do this because Comcast trades at a low multiple relative to all of its peers, both in the cable space and in the media space. And the thought is, they're getting a conglomerate discount, and by splitting it up, the thought is they're going to be able to unlock more value. Comcast executives said on the call where they explained why they were doing this, that basically both the broadband cable business and the media business, NBCUniversal, are facing a lot more competition than they have been in years past. And so the idea is if they're split up, they'll be able to focus on really competing in this, this new world.
Speaking of competing in the new world, is that any reason why BT and Verizon seem to be teaming up now?
Yeah, it's all part of the same theme. So BT and Verizon, by announcing this joint venture where they're combining their international operations, they're basically acknowledging that international hasn't been as great of a performer. They're both using it as a way to really double down and focus on what they see as their core business, which is their local assets. So for BT, that means the UK. For Verizon, that means the US. Because it's a joint venture, they're able to offload it off the balance sheet, but then still participate in any upside that comes from really, smushing these two together, removing duplicative costs, and using scale to their advantage.
What are they going to talk about when you're at Sun Valley next week? I feel like we already have all the media deals.
I know, all the deals have gotten announced. I mean, honestly, the Comcast deal is the most interesting because a lot of analysts have already speculated that by doing this, it's going to open up both the cable piece and the media piece for more M&A. Charter stock surged on the news Monday on the, assumption that maybe something could happen. So I'll definitely be asking about all that.
Next week could be interesting. We're excited to talk to you at Sun Valley itself. Michelle Davis, our Bloomberg Deals senior reporter. Another story that we are watching this morning, the market debut of Italian tech company Bending Spoons. Its shares are due to start trading on the NASDAQ at any moment, and Bloomberg's Scarlett Fu has more.
Hey, Danny, that's right. Bending Spoons raised $1.68 billion in its initial public offering after selling 58 million shares for $29 apiece. And right now, it is indicated to open at $32. The Milan-based tech company has bought dozens of internet companies of a certain vintage: AOL, Evernote, Vimeo. You get the idea. A few years ago, the CEO Luca Ferrari was quoted as saying that he sees Bending Spoons as a hybrid between a private equity firm and Google, and its playbook reflects that. Bending Spoons takes on leverage to buy subscription-based services, fires employees to cut costs, hands operations to coders, and then raises prices. Bending Spoons has grown its monthly active users almost fourfold from late 2023 to 500 million, and it has stopped losing money, reporting net income of $28 million in the first quarter on $600 million in revenue. The growth story is that Bending Spoons plans to make more acquisitions as it aims to bring old tech businesses back to startup model. Now, the plan does seem to be working as Luca and his former college friends, three of them, have now emerged as Italy's youngest cohort of self-made billionaires. Danny?
Not too bad. All of these people between the SpaceX IPO and now bending spoons making some serious money off of IPOs this year. And CEO Luca Ferrari will be on Bloomberg Business Week later today. That will be in the 2 p.m. hour. Elsewhere in the world of deal-making, Blackstone selling a stake in a trio of data centers across Northern Virginia for $3.5 billion. The assets involved are part of a joint venture between Blackstone and Digital Realty, which will continue working together on the remaining data center investments elsewhere. Bloomberg's Anthony Hughes joins us for the latest. Anthony, what are the details of this transaction?
Well, it was really interesting timing, this deal. It happened right at the end of the quarter, or in the end of the half, and basically for Blackstone, that enables them to basically realise these stakes in these data centres. And now it's sort of unusual in a sense because Blackstone's been a huge buyer of data centres, but here we're actually seeing them sell stakes in data centres in Virginia, which is the biggest market for data centres in the US, But Digital Realty, which is one of the largest REITs, one of the largest data center REITs, they have a big appetite to buy these data centers, particularly when they're complete and they're stabilized. They're actually generating revenue. Blackstone is really developing a lot of data centers. It also has some funds that are looking to buy completed data centers as well. So so from Digital Realty's perspective, they're buying their main business is data centers. So they're buying some more. They're doing it in an accretive way. And Blackstone here sold these stakes. It was sort of a capital recycling exercise for them. Right at the quarter end will help their results. It was a sort of unusually timed deal.
All right, Anthony, thank you so much for bringing that story to us. That's Bloomberg's Anthony Hughes. Coming up, Sullivan and Cromwell leads in M&A for the first half of 2026. Their global head of M&A, Melissa Sawyer, will be joining just on the other side of this commercial break. As we close out the first half of 2026, it's time to take a look at the big picture. We're looking at MA Go, which you can find on your Bloomberg terminal. There you can also search who are the top advisors. If you look at legal, it is Sullivan and Cromwell leading the pack. It has 26% in market share with more than $468 billion in deals, putting them at the top of the league table. So a perfect time to speak with Melissa Sawyer, who joins us now, Global Head of M&A at Sullivan and Cromwell. Melissa, thank you so much for joining.
Thank you.
Have you been sleeping at all in the first half of 2026?
It has been a very busy year already across lots of different sectors and types of deals. It's been fun.
I mean, looking at some of the deals you've been on, you have some really big names like SpaceX and then buying XAI, Cisco, and Restaurant Depot. I just wonder how you rank the health and sustainability of what we've seen in the first half and what it means going forward here in 2026.
Well, I think it's actually a really healthy M&A environment because what we're seeing is deals of all sizes in all sectors. And it's not just one or two blockbuster transactions, but there's a lot happening, and it's global, it's cross-border. And so for me, that means that the pipeline will continue to refill as those deals run off.
Just on that one specific deal, as much as you can, I mean, the SpaceX deal, I feel like Elon Musk is notorious for like cycling through people, but he's really stayed with Sullivan and Cromwell. I wonder just what it takes to not only get a high profile client like that, but to make sure they're satisfied and stay with the firm.
At the end of the day, it's client service business. It's about being responsive. It's about being smart. It's about being committed and finding creative solutions to what they're trying to accomplish. I think a big part of it is understanding what their strategy is and just helping them execute on it. You can't just come in and be episodic and show up on the day of the deal and expect that they're going to want to hire you again.
It is one of these mega deals. What do you think the split is going forward? Because the comment has been made, and you said this isn't necessarily what you're seeing, but it is just like the era of mega deals. And maybe the small and mid cap aren't as robust as what we're seeing on the top line. Is there a split where you think that the smaller and mid-cap deals have some catching up to do with just like the amount of mega deals we're seeing?
Yeah, we'll see more small and mid-sized deals once the private equity market comes back a little bit. That's been pretty anemic for the last year, but it won't stay on ice forever. And I think once that comes back into play, we'll see more of that.
What does it take for that to come back?
I think a healthier and more predictable financing environment. I think right now the strategics are actually being really competitive in what they're able able to pay for assets, in part because a lot of them are going through these kinds of transformational changes around AI and sort of embracing adjacent strategies to what they do today. And it's hard for private equity to compete with strategics who are motivated because the strategics get synergies out of their deals that private equity doesn't get unless they're doing some sort of a platform strategy.
Is there any element of the pace of strategics in corporate M&A that we've seen is just the regulatory environment is favorable, and so there's a rush to just get deals done until, I don't know, maybe things change at the midterms or something of that nature?
I mean, people say that. I think if that were really true, we would see more activity in healthcare and traditional tech, because those are the two sectors that were hardest hit under the last administration by our very tight regulatory policy. And actually, we're not seeing a lot of frothy M&A activity in those two sectors at the moment. And so I don't think we can attribute everything to the regulatory environment. It's a healthier regulatory environment at the federal level in the U.S., but outside the U.S., not much has changed. And even within the U.S., the states are getting very active. So there's still a lot of hair in any sort of regulatory analysis and a lot of preparation needed to get deals done.
We talked about this when you were on the show in February, this idea of, yes, federally you can get things approved, but you face this backlog when you come to the states. I mean, even California's AG going after the Warner Brothers Discovery deal, does it seem like it's gotten worse since the start of the year?
I think it has, personally. I think the politicization of antitrust at the state level is gaining as we go through time, and as we approach the midterm elections, we'll probably see even more of that. I just think companies need to be prepared with their messaging to make sure that what they're saying about their deals not only appeals to shareholders, but also appeals to labor unions, appeals to consumer advocates, and all the other stakeholders in that state ecosystem.
Are there deals that you've looked at, that you've maybe advised on, or you've said, look, this looks possible that it'll get past federal regulators, but it won't in the state, and that's a reason maybe to not pursue a deal? Is that occurring right now?
You know, I'm not in the business of telling people they can't get their deals done. I like to facilitate transactions. I think the conversation is more about, here's an area where you may run into some friction, and here's some steps that you may want to take in the planning process to make sure that when you encounter that friction, you're fully prepared to deal with it.
By the way, on the federal side, does it seem like there's any type of deal that can't get done? I mean, we were talking about, even earlier this year, of potentially two of the biggest airlines in the United States merging, something that I think people couldn't even dreamed of before. Is literally everything on the table right now, Melissa?
So no, and I'll give you a really easy and obvious example. I think if a Chinese buyer wanted to come into the States and buy a hyperscaler, that's not going to happen.
Right.
And so there are certainly examples of deals that I think would be very difficult to get done right now.
So yesterday, or the day before yesterday, we got a Supreme Court ruling in the Slaughter case that essentially said, yes, the president, the administration can remove heads of various agencies with cause, or at will, rather. And I wonder if that introduces any regulatory volatility into the picture for you, for your clients, especially this idea that perhaps regulatory agencies maybe have some consistency through administrations, if that completely removes any veneer of that continuity.
There's always going to be continuity because at the staff level within the agencies, you have career civil servants who are economists and whose job it is to analyze data that supports the analysis that they do of transactions. That hasn't changed at all. I think it has always been the case that at the most senior levels where there are political appointees, it can change the tone from the top on transactions. And I think that Supreme Court decision, while it has important implications, hasn't moved the needle that much. So I wouldn't overstate its significance in terms of shifting regulatory policy. We'll always see a shift in tone with each new administration that comes in.
How much, I guess, what is the kind of line between a shift in tone versus actual policy? How often do you see, I mean, you were kind of talking about this heading into the midterms, you get this kind of rhetoric from politicians. Yeah. I mean, does it seem, it's a Trump administration that seems like they were talking about a lot of deregulation, and we have gotten a lot of deals coming through. I wonder where you sort of draw the line in between what's talk and what actually gets enacted into policy and makes a difference for your clients.
Yeah, I mean, there are a lot of changes, big and small, that make a difference. To give a couple of examples, on the SEC side of things, this SEC is working very hard with deal makers to try to come to practical solutions that solve, in some cases, really little problems that don't get a lot of daylight in the press. But this SEC, for example, came out and solved an issue that related to how quickly you have to do a broker search on an M&A transaction. This is not the type of issue that anybody gets fired up talking about, but it was a thorny technical issue that they came in and fixed. So there's a lot happening behind the scenes that has actually been very helpful from a deal-making perspective.
That's really interesting. I do wonder, though, just how complicated this environment has gotten, not just from the regulatory side, but from the technology side. And you can put regulatory in with that when you have a Trump administration, for example, kind of dictating the top models that Anthropic could sell or wanting to take stakes. The technology is changing in real time, as is the regulation. Just how difficult is this sector, any sort of thing that touches AI, to due diligence right now?
I mean, it is a crazy time. That's probably our biggest practice area right now, is doing AI, compute, and energy adjacent transactions related to that industry. It is the biggest disruption in any industry that I've seen in my lifetime. I think policy is one piece of it, and there are elements of the policy that are actually incredibly helpful in allowing, energy policy, for example, to support investment in that sector. There's too much demand. There's not enough supply right now. Prices are nuts. The size of these deals, which in many cases don't even hit the league tables because they are more in the nature of project finance deals, is dwarfing anything else that's happening in the market. And on top of that, you're seeing investment bankers who used to brand themselves as TMT bankers, they're now branding themselves as digital infrastructure bankers. So the entire ecosystem of deal making is shifting into this new linguistic environment where people are talking about AI differently.
By the way, one of the places in terms of AI that people said, oh, this is going to be really disrupted, is law firms. Like it was, oh, you're not going to get these juniors coming in. The work that they were doing is going to be done by AI. How much of that disruption have you actually seen at Sullivan Cromwell?
We haven't seen a disruption in training yet. We are still hiring like gangbusters. We almost can't get enough talent. We want more. I think the big difference is now we have these much more sophisticated tools for people to work with, and we actually have to make sure that our more senior lawyers are also learning how to use them so that they can exercise oversight over what the more junior people who are more AI native are doing.
I say, looking at that league table, I can tell why you need more people.
Yeah.
Thank you so much for joining. Such a pleasure to catch up with you. Melissa Sawyer, Global Head of M&A at Sullivan & Cromwell. Coming up on the show, beloved children's brand Care Bears has been sold to Authentic Brands Group by Cloverlay and iVest. Jeff Collins of Cloverlay will discuss the deal and the value of IP as an asset in our alternative view. This is Bloomberg Deals. It is now time for an alternative view. This week, private equity firms iVest, Consumer Partners, and Cloverlay sold the Care Bears brand to Authentic Brands Group. Jeff Collins, managing partner at Cloverlay, said Cloverlay's strategy is to identify assets that fall outside of traditional PE allocations. We viewed Care Bears as an intangible and misunderstood IP asset with asymmetric upside potential. And Jeff joins us now. I love something about taking this lovely nostalgic children's brand and saying oh yeah, there's asymmetric upside. Look, so you bought this in 2023 from the Weiss family, who'd owned it for about 40 years. Why even buy it to begin with? What was the growth thesis for, again, this brand that's maybe more of the 1980s?
So Cloverlay acquires uncorrelated private assets, and they can be tangible or they can be intangible, but they behave in very unique ways because they are not operating businesses. So in the case of the Care Bears, on the intellectual property side, an intangible asset, we own the IP. We don't make backpacks, and we don't make T-shirts, and we don't make movies. But we collect and build a global, durable stream of licenses and royalties based on the intellectual property of the Care Bears. And that behaves very unlike a consumer product. That behaves more like a music catalog.
Right, so you don't need to worry about consumers pulling back, of people not buying as many Care Bear toys or something. That's not as big of a concern to you.
The way contracts are structured in this particular segment of IP is always with minimum guarantees. So there will be payments even if no plushie toys are sold in Walmart. However, the contracts are also structured for the intellectual property owner to participate in the upside of really strong sales. And that's one of the things we were lucky enough to witness with
on this
Care Bears.
IP itself, is there something to the nostalgia economy right now? Is that part of the thesis?
The power of the brand is remarkable. And Cloverlay, looking for sort of undiscovered assets, we're looking for something that felt like the Care Bears feels before knowing the Care Bears would be available. And we were looking at iconic, boring, overlooked. Everyone thought the Care Bears was much, much larger than it was. But there's a lot you can do with a brand that powerful, where everyone smiles when you say, well, the last deal we exited was the Care Bears. And they say, I need to know more about that, please.
Well, I mean, to the point of it being smaller than people thought, it was reported when you bought it that the enterprise value was around $100 million. Like, what sort of returns did you get from this thing on exit?
It's a great exit in less than 3 years. And I think in the press releases, we talked about the knowable, findable growth in revenue, both at the storefront as well as inside the company. So it's just been a great result for us.
So again, your assets, to your point, looking for very uncorrelated things, like everything from Broadway touring rights to wildfire fighting helicopters. Like how do you find experts? Because it's not like you're like the biggest platform out there. How do you find the right people to take these assets and grow them when they are so different?
Our commercial license is to have lived in each of these pockets for decades and have incredibly strong and deep networks of potential operators, potential sellers, potential targets. And then when the constellations come together, as they did in the case of the Care Bears, it becomes very, very obvious. And whether you're talking about firefighting helicopters or planes, or you're talking about the Care Bears, or you're talking about obscure corners of litigation finance, there are common traits across each of our assets because they are assets.
Any other?
And usually you can grow them.
Any other like esoteric, nostalgic IP you're looking at now?
We're looking at a lot, but we don't want all of your viewers to know what we're looking at. Just put it this way.
Like a flavor, a sprinkle.
We have been looking very closely at some of the royalties that are embedded in both film and television that no one has really thought about how to strip out a piece of the royalty stream.
I know you can't give away too much, but is that like music or?
It could be. It could be music. It could be a lot of different things.
Okay, well, I hope you'll join us when you do some of those deals.
Would love to.
They're endlessly fascinating. Jeff,
to.
I appreciate you fighting the World Cup traffic and coming up to here in New York.
Thank you.
Really appreciate it. That is Jeff Collins, managing partner at Cloverlay. Coming up on the show, the AI build-out is driving power demand. In our investment committee, we're going to talk with some of the top deal makers in power and infrastructure. That's coming up next. You're watching Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Global M&A is on a roll, judging by the tally in the first half of the year. Let's go to Scarlett Fu, who has more on the record pace of deal making.
That's right, Danny. Never mind the Iran war, economic anxiety, and political uncertainty, because companies and their bankers around the globe looked through the volatility to announce deals worth $2.6 trillion in the first 6 months of the year. That is the yellow bar at the end here. So if this pace continues, deal makers are on track to top the previous high set back in 2021. This other yellow bar. You can credit the regulatory environment. The Trump administration prides itself on being business friendly, as well as strong corporate earnings and record stock prices for inspiring cross-border purchases. And you can't forget AI. Companies feel an urgency to add scale before technological advances forces change upon everyone. And there was a wide variety of transactions in the first half, starting with big deals. There were 38 deals valued at $10 billion or more, and notably a pickup in activity across sectors. Unilever, for instance, sold off its food division to spice maker McCormick for about $45 billion. In real estate, Avalon Bay Communities and Equity Residential joined to create a developer worth more than $50 billion. And NextEra Energy's $67 billion bid for Dominion, that will create a U.S. energy giant. Danny?
Scarlett, thank you so much. And a perfect segue, because that brings us to this week's investment committee. We're going to talk about that last sector that Scarlett mentioned, and that is power, utilities, energy, infrastructure, where we debate the boardroom debates in real time here on the investment committee. Joining us for today's IC is Bloomberg Deals reporter David Carnevale. Andrew Calder, he's executive committee member at Kirkland and Ellis, and George Bilicic, he's managing director and global head of power, energy, and infrastructure at Lazard. Thank you all so much for joining. And I got to say, no two better guests, because you both were directly involved in the NextEra Dominion deal. I would love to know, because we've had these mega deals in the industry. And George, starting with you, it's a massive consolidation wave. Is more to come? Are we still in the era of mega deals? Are you expecting more with price tags of $100 billion plus?
We think there'll be steady consolidation across a number of industries, and including in the energy industry, whether it's utilities or otherwise. And there's no reason for it to stop, but I would also not expect it to be rapidly accelerating. And there are different drivers for that, which I'm sure we'll discuss.
We definitely will. But Andy, let me get your pulse check too. Still in the era of the mega deals?
Yeah, same thing. I mean, look, it's all based on artificial intelligence and the demands on the grid. And so as we continue to see that accelerate, I think you're going to see, obviously, the same acceleration in M&A in the energy space.
What about smaller deals, right? I mean, it really stood out to me that one of the rationale for Dominion to do this deal with NextEra as a target was the idea that Dominion wasn't big enough. We're talking about a $60 billion market cap company, right? So big, but it wasn't scaled. So what about the 5, 10, 15, $30 billion market cap companies in the utility space in particular that are very local, that are very, I would say, in a way, subscale, and maybe they don't have the balance sheet to face this demand that is coming to them from the AI buildup. So is this a good time for these companies to, A, consider mergers so to gain scale, or even take private transactions where in the hands of private equity owners or infrastructure funds, they could have those deep pockets that they need to really navigate this environment?
So it's a great question. It's historically in the industry, the utility industry, there's been this steady wave of consolidation, sometimes because companies feel like they're too small. And you'll definitely have some companies who decide to merge or transact because they're worried about scale. But also these companies are regulated, and they have the support of regulation, and the size and scale benefits are sometimes hard to see. So I would not expect a wave, but I would expect some things like this to happen, and they've been happening.
Andy, can I get your thoughts on that? Just how much regulatory overhang there is? Because this is an administration which, yes, is dealing with an affordability crisis, but has been more friendly when it comes to M&A.
Yeah, look, I think there's general recognition in Washington that we need to win the AI race. And I think as a result of that, there is a vested sort of interest in making sure that there can be consolidation. And at the end of the day, all of these deals reflect a need to get access to capital.
Even if it impacts affordability ahead of the midterms?
I think that will obviously be top of the priority list for many of the regulators, and I think it is top of the priority list. I think the difference with some of these deals is they're not being done to try and get cost savings or synergies. They're really being done to try and get access to capital. And I think most of the counterparties, they're not only looking at access to capital, but they're looking at trying to keep rates relatively affordable across the board. So.
And Andy, I mean, this is all part of a big infrastructure play. You guys with Kirkland have been ahead of the curve in terms of really investing in this market, in terms of building the practice, which is now one of the growth engines of the firm. What did you see 10 years ago when people were looking in other directions and not paying attention? And how has the market changed in the last decade in terms of scale, in terms of players that are coming in? How have you seen it evolving?
Yeah, I mean, one of the fun things about being an infrastructure lawyer is it's a rapidly evolving space. It's very dynamic. And so when I first started doing energy and infrastructure, it was really in the midst of the shale boom, which then led to midstream and LNG expansion. Now, in the last 10 years, I would say, look, you wouldn't have been having a panel on energy and utilities 15 years ago. It wasn't a very exciting space, but with the data center expansion, digital infrastructure, we obviously lead that market, and we see it across the board. And as soon as you see that kind of explosion in one space, it's going to lead to corresponding increases. So energy has been great. Power and utilities is a really exciting space right now.
I'm guessing you would probably agree, George, and I wonder how all of that has also changed the pricing of deals versus eras past.
So it's changed the calculus around transactions because it's so driven by the capital investment opportunity and the sheer scale of it, which is just truly enormous. And it's also causing different subsectors of energy broadly defined to bleed together a little bit in terms of strategy and transaction considerations.
So what about, in my mind, there's a distinction to be made between the power sector and the utility sector. So we're talking about generations versus distribution, right? My sense is that the power sector is quite consolidated already, whereas the utility sector is a bit more fragmented. So I wonder whether you guys are spending more time right now in the utility space because you see more room for deal making than the power sector, or how are you playing that game?
From our perspective, I think you're broadly correct in terms of the split between power and obviously utilities, but we're seeing activity across the board. I think you're correct that it's more consolidated, but at the same time it's still an interesting space in generation. That tends to have more project debt and be more of a sort of project level enterprise. On the transmission side, which obviously bleeds into utilities, we just need more investment across the board. And I think everyone recognizes that. And so we're seeing a lot of activity in that space too.
So George, obviously, you and I have talked about how the market is changing, and it's all part of this infrastructure industry. Now you have power, you have utility, you have midstream companies, so LNG, and I wonder whether the lines are getting a bit more blurry in terms of potentially vertical integration. Are we going to see power companies buy midstream companies in the future? What's your read on that?
So a lot of the themes we discuss across our client base are very similar right now, driven by this incredible need for new generation, the fact that most of it's going to be driven by natural gas. And so whether you're a pipeline company, an E&P company, a utility or a power company, you're thinking about a lot of the same stuff. There are different things you're contemplating as well. And I could see, you have seen some vertical integration. So you've seen some E&P companies look at power. You've seen different E&P companies look at LNG. And if you think about the problem that's trying to be solved around a data center complex, you need gas transportation, you need power, you need the data center expertise, you need the electrical wiring, you need all of these sorts of things. And we see over time, a solutions provider developing that can do all of that, which would suggest some blending together of things.
Just one final question on, just to pick up on what Danny was asking about valuations. This market reminds me a little bit of the pandemic in terms of there was a tech situation where you had this massive FOMO and the market was moving very quickly. And now you have AI and people have fear of missing out and people have to think very quickly. Valuations are getting a bit stretched. You have to believe the growth, and growth obviously is very aggressive right now in terms of expectations. What's your read? You obviously, Andy, work with some of the largest infra funds and private equity funds, and they are all over these situations. What are you hearing from them?
So I'll defer to valuations to the banker on the panel. But I would say when you see the demand in data center build out, I think this is going to continue to be a very hot place to invest, and obviously that has its effect on valuations.
But there's always parts, even when things are hot, that we go too far and they're frothy. George, are there any corners of this market that you think have gotten too frothy?
I'd tell you, look at the total addressable market of potential investment opportunity in this broad AI data center technology space, and you can support super high valuations. So you'll see high valuations printed. You see different companies trading at very high valuations, but you can rationalize them based on the total addressable market for investment.
All right, we're going to have to end it there. Thank you all so much for joining. Really appreciate your time.
Thank you.
That's today's Investment Committee Bloomberg Deals reporter David Carnevale, Andrew Calder with Kirkland and Ellis, and George Bilicic at Lazard. Coming up, PIMCO warning of a confidence gap in private credit. Ted Goldthorpe, founder of BC Partners Credit, joins us to discuss investor sentiment and the trends that he's seeing emerge. You're watching Bloomberg Deals. You are watching Bloomberg Deals. I'm Danny Berger. PIMCO noting this morning that private credit investors have become more discerning about dispersion in investment marks, creating a confidence gap between asset managers. This comes on the heels of private credit firms, including Apollo and Blackstone, grappling with elevated retail withdrawal requests in the second quarter, though they still point to robust institutional demand. Ted Goldthorpe is the founder of BC Partners Credit, which has $11 billion in AUM. And joins us now. Ted, great to see you.
Great to see you.
And look, this dispersion among investors has been talked about for some time. And I wonder if we're reaching something of a tipping point where it is real LPs are not recommitting capital to funds that they don't want to be with. And we're starting to see the emergence of more, I guess, like zombie funds in the world of private credit.
Yeah, I think most of the funds that people are talking about are actually heavily regulated, and they have robust valuation processes. So all of our, most of our deals, if not all of them, go to third parties to get valued, and we have auditors, and we have other processes. So I actually think the valuation methodology that most private credit firms use is actually pretty robust.
So that's not a problem. I know, though, you've noted before one issue in the industry has just been the huge amounts of dry powder that people have on their side. You talked about this in one of your early 2026 kind of like credit themes, that they've had to put that to work and maybe taken deal quality has suffered because of that. That was early this year that you said that. Are you still seeing some of those issues in the ecosystem right now?
I think a lot of that dry powder has dried up because people have been deploying, fundraising slowed, and people have redemptions. So I think you put those all together, and spreads are going wider.
So is there a liquidity issue for this industry then?
I wouldn't say there's a liquidity issue. I just think people are being more discerning about deploying capital because people have less dry powder than they've had in the last couple of years.
Well, BC Credit itself exists in this really interesting space because you're not one of the huge mega platforms. You're certainly not tiny either. The comment has been made to me before that maybe it's the sort of ones in the middle with tens of billions that will struggle to survive. I want to be clear, no one's ever named BC Credit in talking about this, but that general attitude that it's tough to be in the middle right now. Is it tough to be a middle market manager, not one of the big platforms, but not small and super, super niche?
Oh, I can't disagree with that sentiment more. We are so well positioned. The 5 managers that we got benchmarked against our last fund have all been sold. So if areas the types of deals we do and the types of EBITDA that we're focused on, like non-sponsor lending or what we're doing in asset-based finance, we just face less competition than we faced in a very long time, just because people have gone way up market.
So are people calling you up every day and saying hey, Ted, nice business you got. Would you like to come on our side?
Yeah, if you want a check of $75 to $100 million, there's just not that many people to call. It's too small for the big guys to do. And the people who are stuck are the people somewhere in between the Blackstones and us. Those are the people who I think are going to struggle a little bit more. For us, we still are able to be nimble and run it like an investment firm versus an asset management firm.
Well, I'm just curious because there has been a lot of consolidation. People want to get bigger. They want to become the size of a Blackstone. And how much you think that there is just going to be a lot of M&A within private capital and among private credit, especially if maybe some managers are struggling? Are you expecting a big wave of consolidation?
I think consolidation is going to actually accelerate, which is right to your point. Size matters, scale matters. It's much more expensive to run these platforms. Much harder to raise capital, much more investment needed. So I think we'll be, again, one of the at the forefront of rolling up smaller managers.
So you yourself, are you looking at smaller managers potentially to buy?
Yeah, so with all this dislocation in retail, people talk about the big 5 or 6 firms. There's the top 10 firms manage $90 billion in the interval channel. The next 300 firms manage $30 billion. So there's lots and lots of small little funds that just can't make money, and those are really good consolidation candidates.
What kind of things are you looking for? What is the checklist? What is the due diligence in finding firms that? Because there's a lot of egos in this business. M&A is difficult. So what do you look for in terms of someone you'd want to bring in house?
That's a good question. Some of these deals for us provide strategic benefits. So they have some niche or vertical that is very strategic for us that we can originate new types of debt, and others provide us additional permanent capital. So we can take on that capital, we get to bigger size, and we can provide bigger solutions for our clients.
Just finally, Ted, because sports is in the air. England is tragically currently losing to Congo, which I'm glad our viewers aren't currently watching that because it's a heartbreak and they should stay on Bloomberg Deals. You have some really interesting sports investments yourself. It's more kind of around, I guess, the infrastructure and services, not leagues itself. Why go in that direction? Or is that just kind of the start and maybe you'd eventually lend to a league or a team?
Yeah, I just think as more money piles into sports, the ecosystem will benefit. And we're finding great value in places like sports. We own a stake in a sports agency. We own a stake in Riddell, which is a football helmet company. these companies are greatly benefiting from the additional money coming into sports, and it's almost like a rising tide lifts all boats. So as long as investments go into sports, our sports agency will greatly benefit.
So does that mean you maybe wouldn't go into leagues? Are valuations there a little too frothy?
I think there's a lot of like mixed quality things that we're seeing, and there's lots and lots of opportunities, and I think you have to be pretty disciplined about what you invest in.
Okay, Ted, we're going to have to end it there. Thank you so much for coming on. We appreciate your time. Ted Goldthorpe, a co-founder of BC Partners Credit. Coming up, the reigning Super Bowl champions, speaking of sports, Seahawks are for sale. Clearly, Ted's not buying them. And the NBA may expand with new teams in Seattle and Las Vegas. We'll have those stories for you coming up. This is Bloomberg Deals. This is Bloomberg Deals. I'm Danny Berger alongside Scarlett Fu. We just want to check in on AOL owner Bending Spoons. It is now trading in its NASDAQ debut. The company and its backers have raised some $1.6 billion in an IPO priced above its market range. So far, up 10.3% in the session. Remarkable for what ultimately is a software company. Before we go, we want to take a look at some of the latest deals being discussed in sports. Bids are coming in for an NBA expansion team in Las Vegas, and the first bids to purchase the Seattle Seahawks are due on Monday, or were due on Monday, rather. Bloomberg senior reporter Randall Williams has been covering both of those. He joins Scarlett and myself now. Do we know anything about how the bidding process so far has been going for the Seahawks?
Sure. So the Seahawks, they hired an investment bank, Allen & Co., who canvassed the landscape trying to figure out who wants to buy the team. And there have been many rumors. We know that Aditi Mittal is leading a bid. We know that Vinod Khosla is another person leading a bid. There could be others that show up. We don't know those other potential parties, but the two we know are Vinod Khosla and Aditi Mittal, who's backed also by Wyc Grousbeck, who used to own the Celtics.
There are also reports that demand perhaps is not as strong as people thought it might be.
You're going to get Roger Goodell fired up.
I just wonder, maybe because this is an NFL franchise, there's scarcity value, right? All of that.
Sure. So when you have to buy an NFL team, you have to, offer up 30% equity up front, and that's a lot of money for a team that could go from anywhere to $8 to $10 billion. That could be $2.5 to $3 billion. And so there's not a lot of people in the world who can just write a $2 to $3 billion check in cash. Now, these two parties that are interested that have been confirmed, they can. But in terms of the interest that was there for the Commanders or for the Broncos, I have not seen that. Now, Roger Goodell said at the NFL League meeting that there has been tremendous amount of interest. So we'll see.
I guess interest can be subjective. What about interest for an NBA expansion team in Las Vegas? There was some reporting around like maybe one of the Kushner brothers, Bob Iger, being interested in that.
Sure. So one of the Kushner brothers, he has long been interested in Las Vegas. He reported that, or we reported earlier this week, that he is considering submitting a bid. Now, bids for the Las Vegas and Seattle NBA expansion teams aren't due. So it's a bunch of people that are raising their hand and saying, we are absolutely interested. Outside of him, there's Bill Foley, who owns the Vegas Golden Knights in the NHL. Magic Johnson has raised his hand, Mark Lazary. And in Seattle, there is Samantha Holloway, who, of course, is the daughter of the late David Bonderman. And so there are a lot of people who are interested in owning these expansion teams because they're two, markets that I think are appetizing. Vegas, you're not going to have any trouble selling luxury suites there. And Seattle has been deprived of basketball for many, many years. So whoever wins this is, I think, going to be a huge, huge winner.
I'm just still depressed. England is still down.
Uh-oh.
How many minutes have gone by, though?
We are at 46 minutes. Yeah, it's about to be halftime.
You and all our entire HQ2 in London, it's about to explode.
Still 1-0. Still time to play for. Randall, Scarlett, great to see you both. That's, of course, Bloomberg's Randall Williams. And that does it for Bloomberg Deals. Stay up to speed. Even after the show, subscribe to our Deals newsletter. Up next, it's Balance of Power live from Washington.